Greetings, everyone. Happy spring into summer. Weather's getting better here, at least, and the stock market seems to be moving apace, which is great. Still broadening out. So today I'm going to do the usual drill: fiscal policy, monetary policy. Then we'll talk about the economy and inflation. And then I'd like to talk a little bit about equities in the context of demographics. There was a Harris poll taken in the last week or so of 10 Democrat swing states. It was a Harris X poll, and it was for a group called No Labels. It was taken during May 18th to May 23rd. And some of the results were very interesting, and I think are factoring into the way that the Biden administration is beginning to think about both spending and taxes. The bottom line is spending will likely not be as high as President Biden's proposals, and taxes, surprisingly, we think are starting to move back into a capital-friendly stance. So I would say on the fiscal policy side of the equation, relative to our fears, certainly, about capital-unfriendly policies, and certainly policies unfriendly to innovation, we are beginning to feel a lot better. Now, the monetary policy side is also very interesting. The Fed, despite what everyone seems to be saying, the Fed is already starting to react. Interestingly, the money growth rate, so M2's growth, peaked in February at 27% and is now down to 18% on a year-over-year basis. I haven't seen it below the 20% range in more than a year, I think, or roughly a year. So that's very interesting. Anyone worrying about inflation will have to take note of that. 18% is still a very rapid rate of growth, but the direction has changed unequivocally. The other thing that happened this week is the Fed said it was going to unwind some of the bond ETF and outright bond purchases that it made during the depths of the coronavirus crisis. Now, this is only $60 billion, which is nothing when M2 is at roughly $20 trillion and the monetary base close to $8 trillion. But nonetheless, it's a change in tone. Again, those worried about inflation have to take note. Now, the second thing I wanted to focus on is the economy. As you know, we've been talking about a V-shaped recovery for a long time. In fact, we started these calls during the depths of the coronavirus crisis, when I think many were worried about an outright depression. And we began to talk about a V-shaped recovery and started citing evidence from the government's reports to support that case. And of course, that is what has played out. Now we are in a little bit of a different camp. We're essentially saying that businesses were behind the curve even before the coronavirus. Businesses were not keeping up with consumer demand as it relates to inventories. And they were not increasing capital spending budgets. Why? There were two reasons. One, China-U.S. Saber rattling, the trade conflict, and the fear of supply chain issues. And two, maybe more important, was the inverted yield curve in 2019, which, according to the majority of economists out there, and according to post-World War II history, not pre-post-World War II, as we've gone through, would have suggested a recession within 6 to 9 months. And so they were poised for a recession. When the coronavirus crisis hit, businesses shut down. They were already behind the curve, and then they shut down, assuming demand was going to be dead for a while. And what happened instead is the government responded very quickly and pushed out the PPPs, the payment programs, to help people in a time of distress. And consumer saving rate shot up. I believe it got to 35% plus in April or May of last year. So the consumer had quite a big cushion, had never had such a big cushion, and the consumer started to spend. What did the consumer spend on? Goods, non-durable and durable goods, because those were the only items that consumers could spend anything on. Services were pretty much shut down. Now, what's interesting about this is goods make up actually less than a third of all consumer spending. Services make up the rest. So for the past year, the consumer, pre-vaccination especially, was focusing his or her spending on goods, just a third of a typical budget. And consumer spending rose as a share of total spending to more than 40%. I don't think it's been that high in the United States in quite some time. As a result, we believe that consumers have actually been building inventories themselves at home with all these goods, many of which they will not need now, that they can go out and start to spend on services. And we are beginning to see that happen. Now, what we think is also happening is that businesses are still scrambling, trying to catch up. Inventories relative to sales are at a record low. And as a result, that businesses are losing sales, and they become a bit panicked about it. And so the scramble continues. And usually when I hear panic and scramble, it means double ordering, triple ordering to make sure to get those supplies so that they won't lose sales in the future. Now, the other thing that has happened is housing and construction generally. They have been falling, housing starts and existing home sales. Part of the reason for this is lumber prices. Lumber prices have more than tripled in the last year, actually much more than that. And I think some builders, we're hearing anecdotes, just they can't get some of the supplies they need to finish homes, and so they are just going to take the summer off. And we're beginning to get clues that this shift away from goods to services generally, extrapolated or exacerbated, I should say, by what's going on in housing, is having an impact. We do not believe this is going to be sustained. If we're right, there are a couple of reasons. One, businesses, this is going to be like Wile E. Coyote. Businesses are scrambling to catch up to the consumer, but the consumer's left. So Wile E. Coyote's off the cliff, and I think we're going to see a pretty serious drop in commodity prices. We believe, as we've been saying for quite some time, that the bull market is alive and well, and it is broadening towards value and cyclical sectors. Or maybe I should say it has broadened. This has happened, and we thought it would. And we thought it would hurt innovation-oriented strategies. It has done that as well. Now, if we're right and everything I just suggested based on the evidence we're seeing occurs, then these cyclical sectors are setting up for a fall. And that should accrue to the benefit of innovation. Why is that? Well, when we get into a recovery, the early stages of a recovery are when the cyclicals see a burst in revenues and earnings. And they give more growth-oriented and innovation-oriented stocks a run for their money. These growth rates are competitive. They're not sustainable, but at least they're competitive in the short term. And very much of the market is short-term oriented. As you know, our investment time horizon is not 1 quarter or 1 year. It is 5 years. So our innovation-based strategies are suggesting that that the returns available or likely, can't promise anything here, of course, to innovation-based strategies have increased. I mean, it's just arithmetic. Our price targets have not changed. The prices have come down short term. And so our rates of return over the next 5 years have gone up fairly dramatically. And we think that innovation is due for a catch-up. We think this cyclical reset will be that opportunity. One other thing on demographics, the 3 areas where we believe millennials will spend, and I believe Fundstrat would agree with this, certainly stocks, housing. Yes, don't think innovation is going to change that so dramatically, except maybe houses without kitchens. So there will be much more in the way of food deliveries. But of course, this demographic is very interested in crypto as well. And this week, we learned that stablecoins had crossed $100 billion. $20 billion of which is USDC. And that's up tenfold in just 1 year. We also got an update that DeFi now accounts for $67 billion, roughly $70 billion of the value locked in Ether. So that also is up at least tenfold, probably more than that. NFTs, we're hearing a lot about that. So it seems like Ethereum is finding a lot of support. Certainly those 3 are built on top of Ethereum. Of course, Bitcoin which we still believe is the reserve currency of the crypto asset ecosystem. Understanding that stable coins could be giving it somewhat of a run for its money, but we also heard that, or saw through his tweets, that Elon is maybe not as high on Bitcoin as he once was. We don't know. We don't know if he sold what he put on the balance sheet as a diversification from cash. So we have seen a little bit of indigestion from all cryptos because of this. And yet, when I look at where it is right now, it seems to be weathering well. This 30 to 40,000 range seems to be a good testing zone. Frankly, I feel better that we are in the midst of a correction, and everyone's doing a reality check and trying to figure out, all the risks and the opportunities associated with the various cryptos. Dogecoin is amusing. Our analyst Yassin El-Mandra is going to be writing up some of his thoughts about why it will not become the reserve currency of the crypto asset ecosystem. And in fact, a lot of this is based around network effect and the security of the network, which is all important when it comes to transferring large sums of value. And so our confidence in Bitcoin has not diminished at all. So we couldn't be more excited about innovation first, but also thinking about how the equity market is powering through all of the risks that it has faced during the last year. I am becoming more optimistic that we're in a very strong bull market that will once again be very good to innovation-based strategies, as well as many others. So with that, we'll wish you a very happy weekend, and thank you for listening.